All right, welcome back, my friends. It is Tuesday, and I didn't get to go live yesterday. I was busy, but I wanted to go through my trades here and look at the trades of the week, and then some of these hot trades that I'm looking at right now that I'm just waiting on some capital to come in, and I'll be able to jump on them. Right now, buying power wise, I have around $2,800 left with a about 30K left that I have on margin that I'm ready to take out or willing to take out for this, but I'm holding that because that's got to last me the entire year. So that's kind of that's what I keep in reserve just in case we see some huge dump, reversal around March, those types of things that like to come around. So that could happen. So I want to keep that there just in case. But the big play of the week that I should be trading weekly is going to be UPS. I love the fact that I can make 1% per week off of the $100 call right now, even it being at 107. So to give you an example, for this week, I bought 100 shares at $107.70, and then immediately sold the $100 call option expiring January 30th, this Friday, for $890. And so if we do the math there, I'll do some quick math. That is negative 10,770 plus the $890 that I got from selling the option, plus the $100 call option if it executes, if it stays above if UPS stays above $10 by Friday, then I will $100 by Friday, then that option will execute, making me sell my 100 shares for $100 each, bringing it up to 10,000. So left over, that leaves me $120. You divide that by my initial investment of 10,770, and you get a whopping 1.1% return on a weekly trade. All right, so 120 bucks a week on this, as long as the UPS stays within that $107, maybe up to 110. I don't know, but as long as I get that $100 call for a one. So as long as I get that 1% return on UPS at a $100 call, I'm going to easily get into that weekly. And as long as that stays around there, I can potentially make 120 bucks, 100 bucks a week is really the goal, 1% per week, and off of $10,000, that's perfect, because right now my margin loan, I just saw where I was charged $498 interest, with the average margin at $132. My margin's lower now, down to 120 used at most, which is not the case because I have cash on hand, but up to 120. So my margin will be lower. My monthly margin payment will be lower than 498 as of now. And so just with that one trade per week with UPS, I could potentially cover the entire margin interest payment just off of that. Not to mention the dividends that I will be getting from all the real estate stock. For example, this one, LTC dividend, the properties, because I'm only getting $38, but I only qualified this month for 200 shares worth of dividend payments. I now own 400 shares, so that will double to 76, as long as the dividend percentage rate stays the same and the price stays the same, around the same. Plus, looks like I got Verizon and AT&T dividends, coincidentally around the same time, February 2nd, coming up for a combined 80, 96, 75. So not bad there. So I mean, just combining all of those together in the coming months, that covers the interest payment. Everything else will come in, will reduce, go straight to principal and reduce margin. And as of right now, it's 120. So keep it back. Last year, I started with 136 just to get to the $200-ish thousand range. So just to show you, this year we're at 120, and we have 217,000 in holdings. 217. So that's huge. That's huge. And the margin used is 117. That's big news. We're starting off hot. Within there, I have GOSS, GOSS. This was more of a play around stock with some friends that they told me to get in, so I wanted to do it and sell some options on it to see if I could make a quick profit. I probably made a 20 to 50, 60% profit on those. However, we're talking about right now the shares are at $2.73. So you do the math. If I own like 400 shares and made a 50% profit, it's not much. But still very happy. It was fun. Looks like the last option. Oh no, I did sell a $3 call option. Wow. There's quite a bit of profit in those to be made still. Depends on if next year the price of GOSS can stay around $3, then I will come out on top. Maybe 100% return. I'm not sure. Not too interested. Again, very minimal. And I mean, let's look at the portfolio size. Less than 0.2% of my portfolio. Very insignificant. Other big plays, Hecla took a big dive, now at $29. That's incredible. I would love to see it go down to 25. That would still be amazing because I can get in some good plays in between 25 and 15. I've got some plays locked in between those at 21, 22, and 20. But those I'm not too worried about. I would love to play in the short term. Most of those are long term. I've got the 21 expiring in February 20th, so it could go down as low as 21, and I'm still in a great position. Right now, even with the 500 shares, it's less than 5% of my portfolio. So I'd love to sell one of those plays and start trading that one weekly. I think you could make 5% off of that a week, depending on where the price is at and the volatility. And it's going to be volatile for a long time, for at least this year. Nike, I don't have the capital right now to risk getting into that one because I lost it. There it is. Right now, it's still taking up 6.27% of my portfolio. So if I bought an additional 100 shares, it put me above that, closer to the 10 range, and that's just too risky. I did that last year. It did not pay off. So maybe I should do it this year, and I will, but I've got to earn the money through dividends, etc., to get to that point, or I've got to get a good price at 55. Right now I'm sitting at 8% potential with not much slippage there. So 8% at 55. With the dividend be around 9%, maybe 10. But that would really lower my risk. 10% to reduce on that, that's 550. Or $600. That would reduce the top 85 one down to 80, which is huge. No profits. Yeah, I will be making a play on Nike for sure. That's not bad timing. I would love to make 15% off the bottom though. So what would it take to make 15%? Just lock it in. Yeah, I'd have to go above 13% is all it's risking right now. I don't hate that. The 60 at 11. Yep, I just gotta reduce. I gotta make some more earnings. I don't want to increase my position in Nike to 10% of my portfolio again. Because it's risky right now. It's an apparel company, I guess. I thought it was gonna bounce right back. After this quarter, it could go back up. I'm looking out for Nike. I'll let you know when I jump into it. Oh, it's 60. That's perfect. I want to sell an option for 55 right there. Get a 2%. That's another one to look out for. Oh, I would just get in it now and sell that option. Sell the January 15th $55 option. That's at 2% gain there, and on top of the dividend rate, 7.34. That's a little low. Yeah, I might wait on that. For the 55 though, you could sell the 60. I've already sold the 60. There you can make 4.79 plus what I just said, maybe 5. So you're in the 10%. Boom, and you're getting a dividend monthly. So you're getting 5% of that monthly upfront, which you can then either buy more stock or invest in other things. That's what I'm looking at. Pay my margin interest payment. And I still make a cut directly off of just the dividend. I make the spread. Kroger, solid buy right now. Coca-Cola went up to 73. Darn it. That one I did want to trade weekly at 70. Now it's probably out of range. This is a play, risky play that I get into that I just haven't been able to exit. You know, I have my pre-market strategy and then I find ways to avoid it. This is one. Because I've just made so much money off of it that I want to keep going into it. And if it's a good company, then it'll be fine. The problem is it doesn't pay a dividend, and that's why it doesn't qualify in my portfolio. But I'm up so much on it that I can take these risks and be completely up on this stock. So keeping it. Anyways, I made a play here. The stock is SMCI. It's at $31 a share, $31.30, and I sold the February 20th call option for $430. So huge little margin, maybe like a 10% boost there. Because 29 plus 400, that would be 30, 33. And it's at 31, or just right now. Which means I wonder what I bought it at. I bought it at $31.50. So yeah, you're looking at a huge profit there. And I'm willing to take that because I'm covered all the way down to $20 a share. I'll be making money. So if for some reason it dropped down to $20 by January, I would be able to sell that one call option for a ridiculous amount, 50% return. Let's just look at what it would be at right now. 2020, January 28. Yeah, January 28, I could sell one right now for 40%. So you're looking at 30%, 30 to 40% off of that one trade. That's almost $1,000. That would pay. Let's just say 1,000. Let's just go with 500. That would pay for the top of the ceiling for SMCI that I have at $41 a call, which I've made so much money off of that one. But taking about $800, you could bring down your cost basis down into the 30s, low 30s, if I wanted to. But I'd just sell the 41. Even the 41 as of right now is selling for $1,000. It's just that one's just an incredibly risky stock. I got in early, made an incredible play, so I've stayed in it, made another incredible play because of that one. And so that is some of the potential of taking some of these higher risk stocks. Even even something like UPS where I was at 120. Just imagine what I could have sold it if at the beginning, if right now it was at 119. Instead, it's at like 107, and I still got a pretty good bit. I think I made 10% off of the top, off of the ceiling, meaning that I made 10% just off of selling the covered call. If the stock ends up at 120 or above, that's probably an extra 10% off of the equity of that stock, of being forced to sell it at 120 again, plus the dividend of it's like 8%. So that's an incredible play where you can turn in a bad play by hedging it properly into a fantastic play like this at 100. If I got stuck there for a week, I would go ahead and sell that $100 call for January 15th of 2027, and I could lock in, let's see, I could lock in the $100 for 6.32% right now. If it got lower to 100, you'd lock in an even higher rate for that $100 play. But 6% plus the dividend that is paying right now of 6%, 12% right there. Dude, 12%. Lock it. Not a bad play. 12% on 10,000. Dude, I'll take it. An extra $1,000. Boom. Because the name of the game is 60K. We can get 60K. That'd be sweet. Well, here's another risky stock that I'm in, that I'm debating to go in. I probably will once I get the capital. A weekly trade on DraftKings at $30 right now. That's a sick one. I can make 2% just tomorrow, just for selling it Wednesday, Thursday, and Friday. February 6th, make a 3.89%. So I'm going to start trading this one for probably 2% a week. This one a riskier trade, but 2%. Just because I'm already stuck in it at $50, at $37. If I get stuck in it at 29, 28, I might do the $28 call for February and see what happens. That's locking it in at 4% return. Yeah. What's a nice good 4%? And start getting 1% per week on it? Come on. Cool with that. That's what we're going to do. That will likely be the play tomorrow, because I just paid my interest, so I got a month to make up that extra $500. That is what I'm gonna do. All right, guys, that's all I got for today. Well,